The stock market has fallen significantly throughout 2022.
The market's crashing.
With the S&P 500 entering a bear market down 20% for the year and the Nasdaq plunging a massive 33%. In 2023, many investors may be hesitant to invest in the stock market due to a variety of factors, such as the ongoing impact of the COVID-19 pandemic, concerns about rising inflation, uncertainty about political events, and the ongoing war in Ukraine. This has obviously made investors worried about the prospects of putting their money in the market.
Sell, 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 sell.
But should they be? Or is this a golden time to buy? In this video, I'll take you guys through some actual data on the topic and show you two major reasons why staying out of the market is the biggest risk you'll face in 2023.
It's a huge risk.
Reason number 1. Investor sentiment. With Michael Burry and famous investors coming out and predicting how the stock market will keep falling,
Our friend Michael Burry.
it is no wonder that the general public has grown a little wary. But if you look past all the doom and gloom in the media, you might be able to get an edge.
The odds are in our favor.
The thing we need to realize is that investor sentiment is actually a contrarian indicator, meaning that it's a form of market indicator that tells an investor it might be beneficial to act opposite of what the majority does.
And then I do the opposite.
This is based on the fact that above market returns have often followed unusually low levels of optimism, while below average market returns have often followed unusually high levels of optimism.
Big opportunity, big risk.
Let's look at some data that shows how this works. This graph of the US investor sentiment shows the percentage of people that are bullish on the market. At this moment, only 25% of investors fall within the optimistic category, compared to the long-term average of 38%. Looking closer at this 5-year chart, we notice two peaks of optimism. One from February 2018 and one from January 2021, lasting throughout July of 2021, where around 50% of investors were optimistic.
All right, we're optimistic, yes.
Knowing this, we can go back and look at how the S&P 500 performed in the periods following. In 2018, we see that in the 3 months following this peak, the S&P dropped by 12%, while we all know what has happened to the S&P in the year following 2021.
Thanks for telling me, man. You burning money, we in a recession.
Now, it is important to mention that the strategy will not work 100% of the time.
All you are, my dear, is a contrarian.
But we know that investing into the markets when the majority of investors are pessimistic has historically been a bet with the odds stacked in your favor.
The odds are in your favor.
Reason number 2. Performance in the year following a bear market. This might be the most important and persuasive argument you'll see. In the years after entering a bear market, the S&P has only shown a negative return in 3 out of 12 cases since 1950, according to the Wall Street Journal. In fact, the average return in the 12 months following a bear market entrance has been 23.9%, over double the long-term returns you can expect in the market. However, just looking at this factor alone is not a bulletproof strategy. For all we know, today's situation might very well end up being more similar to the cases of 1973, 2001, and 2008, where the market did not yield a positive return within 12 months. Having said that, this information can still be extremely useful for us as investors.
Useful, you say? Yes.
Knowing that the S&P entered the current bear market on June 13, 2022, just about 6 months ago, we can see that the odds are once again in our favor, and investing in the markets now might not be a bad idea. To conclude, I would like to say that even though there are no guarantees when it comes to the stock market, looking at these two indicators should bring you some optimism.
I'm optimistic.
Even though there is a lot of bad stuff going on in the world right now that might scare you, there will always be reasons not to invest. The media loves emphasizing stories of doom, and people obviously get affected by it. But in times like these, it is important to remember Warren Buffett's quote, "Be careful when others are greedy, and greedy when others are fearful." Thanks for watching! If you enjoyed that video, check out my other video on how artificial intelligence will change the world in the coming years.